Recording in progress.
All right. Good evening, everyone. Welcome to the Tax Resolution Help Center. My name is May. I will be hosting today's session and introducing today's speaker. I will also be coordinating the Q&A chat session at the end of this session. I want to congratulate you all for taking steps in dealing with your taxes. Taxes from all sources, including income tax, payroll tax, property tax, excise tax, and sales tax, represent a 35% to 60% reduction in your personal savings and wealth. As you probably know, those with 1% of the wealth in this country have experts to help them pay a small percent of tax. Our goal is to help you reduce how much you pay in tax by educating and informing you on ways to reduce past, present, and future tax expenses. We think you are entitled to live a happier, healthier life by keeping more of what you earn and getting the tax man off your back. Our goal is to provide you good information with the opportunity to ask questions that are important to you. The presentation itself will last about 20 minutes, plus 20 to 30 minutes for you to ask questions by chat. I will select the questions and present them to today's expert. If you wish, you can include your first name and your state. That would be great. Other than that information, your identity is not mentioned. The information you are receiving in this session is not specific tax advice. If you want specific tax advice for your situation, you are free to contact today's expert or any of our tax experts at Tax Resolution Help Center. As you know, these group sessions are included in your do it yourself membership fee of $20 per month. If you are not yet a member, please sign up today. We need your financial support. And to better understand what might be on your mind during the session, I might include some pooling questions to ask you. I will then finish with a 5-minute wrap up. Also, a survey will be sent looking for your feedback. And finally, this session will be recorded. The topic for today's session is converting equity compensation to cash. 5 rules of conversion. The tax expert for today's session is Adam Neely. Adam Neely is an enrolled agent and works as a tax analyst programmer for Intuit, which owns TurboTax and QuickBooks. He is a true expert in QuickBooks and can help you get your financial statements ready for tax preparation. And with that being said, introducing Adam Neely.
Good evening, everybody. Thank you for that introduction, Maylene. Um, like Maylene said, I work for Intuit. I help to program the business tax software, and I also maintain a tax practice and bookkeeping and financial advice practice on the side as well. And I'm a QuickBooks Pro advisor. So just a little bit more about me. Wanted to talk today about um, different ways of getting paid other than what the cash that comes in your paycheck. So we'll kind of just dive right in. Non-cash compensation for employees. So really just on the highest level, what is it? Um, we kind of goes into some big categories, fringe benefits. I put reimbursements in quotes because a lot of times employers will call things reimbursements and that will make it sound like that's not a taxable, that's not income. But the IRS would usually beg to differ. And then another big bucket is stock plans, stock options, stock awards, things like that that are becoming more and more and more popular for publicly traded companies and even for privately traded companies sometimes. Um, so just talk a little bit about fringe benefits. Before I do, I just wanted to real quick just ask a little poll, and you can just answer in social media or on the chat if you're on the webinar, um, or just answer to yourself. That's fine too. I was just going to ask. So if anybody had ever in their course of their career been paid a reimbursement or a benefit or gotten an award for doing something at work, something like that, and then had a big surprise when their paycheck came and their paycheck was actually lower than it normally is. So if that has happened to you, I can kind of explain it. And what happens is that really the way the IRS looks at fringe benefits, anything that your employer gives you in exchange for the performance of services. So any form of pay, doesn't even have to be cash. And the way the IRS looks at it is that those payments are taxable unless they have specifically exempted them from being taxable. So you can't just give your employee a new car and say you did a great job and not include that as part of that employee's income. Now, that's why benefits and fringe benefits and payments like that can reduce the net pay in a paycheck. So a common example is, maybe your employer gives out performance rewards. If you do something good or win a contest or something at work, they will give you a gift card or even sometimes a cash award that goes, maybe it goes on a preloaded Visa card or something that they'll send to you, or that you can download online. When that happens, if the employer doesn't what we call gross it up, so the employer doesn't actually pay the withholding for you, they will most likely withhold. So say they gave you $100, they'll withhold somewhere around $17, $18, $16, depending on your withholding rate out of that. And they'll withhold it out of your paycheck that comes next. So if that award isn't actually included in your paycheck, physically they gave it to you previously and then they pay you your normal salary later, your paycheck is going to be lower than you expect because your taxes are going to be higher. And you'll even see on your pay stub that the award is listed there, but it's not part of your net because you already got it. These payments are also the value of whatever your employer gives you in exchange for reported on your W-2, most often just on line 1, and maybe sometimes they'll put it. There's a space in the W-2, box 14, that we can tell you a lot of different things about different sources of payment from your employer. And then if your employer, for whatever reason, doesn't withhold taxes when they give you an award like that or a fringe benefit, then you can have quite a surprise at tax time, because you may not realize that by the time you get your W-2, that your income is actually higher than your salary. And if they haven't withheld taxes on the additional money, the additional value that they have given you, then you may owe some taxes in your personal income tax return. So just to call specifically out these quote unquote reimbursements, just because the company says we're paying you back for something, or just because they require to see a receipt, or just because they, something like that, it doesn't mean the income isn't taxable. A true reimbursement is the company paying, for example, your hotel when you're traveling for them. So if you're traveling for work and at the behest of the employer, and you pay up front for your hotel or your plane or your train ticket or whatever it is, and they pay you back for that, that's you fronting them the money for a business expense and then paying you back. That's not taxable to you. But if they pay you back for something that was not required as part of your job, then it is taxable to you, even though they're calling it a reimbursement. A couple examples of that. A lot of companies will give out tuition reimbursements. Say, hey, if you go to school and get this degree or that degree, then we will pay for your school or for some of your school or whatever it is. Some of that may qualify as non-taxable in IRS rules, but anything above and beyond the thresholds that qualify as non-taxable is a taxable benefit. Even though the employer wants you to go get that because maybe you're going to make you a better employee, that education is a benefit for you in the eyes of the IRS. Reimbursement for non-business related purchases. So that's kind of, I mentioned that. An example I like to bring up is like maybe your company says, we like our employees to be green and to save the world. So if you bring us back a solar panel receipt that you put on your house, we'll give you $2,000 to pay you back for it. That's completely taxable. So it even though, you know, the $1,700 or $1,500 that you take away from that may be helpful to pay for that solar panel, don't expect to get the full 2,000. And then one that has caused a little bit of consternation in recent years, moving expenses. Those are absolutely taxable if your employer, if you get a job that you need to relocate for and your employer pays some relocation expenses for you, that's taxable to you. The reason it's caused a little bit of scandal at the national level is because the IRS used to let you deduct that on your taxes as a W-2 employee. And in recent years, that is no longer allowed unless you're moving for the military. It's pretty much the only exception. Okay, so let's go into stock compensation. And I just had a quick little poll as well. Little trivia question for you. What is the first American restaurant chain, or claims to be the first? The restaurant chain in America that claims to be the first company to offer their employees stock awards as part of their compensation. Give you a couple seconds to think about that one. So the answer is the Cheesecake Factory. Interestingly enough, the Cheesecake Factory is one of the only restaurant chains. There probably are others. Looks like somebody mentioned White Castle. Maybe that's the case. That would be a good one. I'll have to look that one up. But the Cheesecake Factory was kind of the first. Usually these service-based employers don't offer these kinds of benefits. It's something that's been kind of only in the realm of big Fortune 500 companies and especially tech companies. But that's changing recently, so that's good. Stock compensation. So it comes in a variety of different forms. Over the years, there have been different types of plans the IRS has put into place to allow companies to either give or allow their employees to purchase stock. There are definitely some that I won't mention here. There are, you know, privately traded companies that will give all kinds of different structured plans for example, if you work for a startup that's planning to go public, a lot of times there will be plans where we'll give you stock in the future as part of your sign-on or something like that. So those can be handled in various ways, but I'll kind of just touch on the four most common ones. Employee stock purchase plans are becoming more and more popular. Essentially what that is I think maybe these are on my next slide. So employee stock purchase plans, ESPPs, RSUs, restricted stock units, incentive stock options, ISOs, and non-qualified stock options, NSOs. So the basic info about each one of these. RSUs, restricted stock units, are generally like bonuses or like annual awards, things like that. They are granted to an employee, and the employee has to stay with the company for a given amount of time in order for those shares to vest. So vesting means you actually get them. You're granted the shares, but they're kind of in limbo until they vest. And I'll talk about the kind of tax treatment of each one of these after I kind of do an overview. So employee stock purchase plans, that's a program where employees have the option to purchase stock, their employer's stock, at a discount, most often at a 10 to 15% discount. Usually you're only allowed to buy and sell the stock during certain periods of time. They have to have windows that the employees are allowed to trade their own employer stock. ISOs, incentive stock options, generally for like higher management, director level, C-suite level employees. And then non-qualified stock options are very similar to incentive stock options, but the key difference is that they are allowed to be given to contractors in addition to employees. So just to circle back to the top of the list, this is kind of what happens. There's basically two, it gets more complicated, but you can think of it as there's two events. At the time you purchase or receive the stock, and then at the time the stock is sold. So in RSUs, the fair market value of the granted stock is included as ordinary income in the year that it's granted. So when you actually receive in the year that it vests, so actually in the year that it's vest is the year that the income gets included, but the level of income is determined on the date that it's granted. So say that on November 1st, your employer grants you 10 shares. And on that day, those shares are worth $500 a piece. So you have $5,000. 6 months later, they vest in the next tax year. Even if they've gone up or down, doesn't matter. The fair market value on grant date is what gets included in your next year's income when they actually vest. And then when you then go and sell those RSUs, you really only have to deal with the capital gains, whatever, or loss, whatever the situation is. There is one little caveat that we'll get to with RSUs that make it tricky on your tax return. ESPPs, you purchase the stock at a discounted rate. That discount amount, so the difference between what it's actually worth and what you paid for it, is included as ordinary income, but it's deferred until you sell it in the case of ESPPs. So when you buy your stock, even though you have technically gotten a benefit, you now own something that's worth more than what you paid for it. The IRS in this situation allows you to hold off on paying any taxes on that until you actually sell it. Incentive stock options, they get a little more complicated. When you exercise them or purchase them, usually ISOs are purchased at a steep discount. It costs something for the employee to exercise it. When you exercise it, nothing happens in your tax return, except that if you are required to pay alternative minimum tax, there's a whole section of tax law that's alternative minimum tax. It gets calculated in your AMT calculation. The vast majority of taxpayers don't have to deal with AMT, but if you did, ISOs are definitely something to consider, and ISOs influence whether or not you are required to pay AMT or not. When you sell ISO shares, it depends on how long you held on to them. In all these cases, the specific treatment kind of depends on how long you held on to it. But if you hold on to ISO shares long enough, the discount that you received is essentially ignored for tax purposes. Huge tax benefit. If you sell them quickly, you are likely going to have to pay income tax on that bargain element, the difference between what you paid and what they were worth, and also you're going to have to pay capital gains. So in ISOs, it's also a little different because your basis is only what you paid for it sometimes. We'll get to all that. Non-qualified stock options, NSOs, very similar to ISOs, except that there is no the bargain element, the difference between what you pay for it and what it's worth, is always included as income in the year that you purchase it, that you exercise the options. There's no benefit there for ISOs. Okay, so I'm talking a little bit about when you sell it, when you don't sell it. What we call that in the tax world is qualifying dispositions versus disqualifying dispositions. Basically, if you hold it long enough, it qualifies for advantageous tax treatment. If you don't hold it long enough, it doesn't qualify, and it gets treated as any other sale or income that was being deferred is now taxed. So the definition for ESPPs and ISOs of a qualifying disposition. You have to sell it more than 1 year after you purchase for ESPP or exercise for ISOs, and more than 2 years after they were granted to you or offered to you. The offering date for an ESPP is all in the plan. So it'll be like an offering date of September 1st that you're allowed to then purchase on January 1st. So more than 2 years after offering date or grant date, more than 1 year after you actually receive the shares. So what that means is for ISOs, I kind of touched on it, you get a very, very large tax benefit, which is that your bargain element, oftentimes 75% discount that you received on the taxes is ignored and you don't pay taxes on it. And you get a smaller but similar benefit for ESPPs if you wait that long. Factors to consider if you're kind of weighing, should I wait? Should I not wait? What's your overall income? What is your tax bracket? If you do have to expose this bargain element to taxes, what is that hit going to be? Are you way up in the 37%? Or if you're down in the 20% tax bracket, then maybe it's not as big of a deal, or even potentially lower. You want to consider the potential value of the stock. Now, of course, I would never advocate playing the stock market and guessing what's going to happen to a stock. But if you feel like the stock is likely going to go way up in value, or you have some reason to believe it's going to go down, or it's at a peak, that may influence your decision. Because the benefit of selling now may be greater than the taxes that you're going to have to pay because it's disqualifying. And then future taxability, something we think about a lot is, if I hold on to this for 10 more years, what's my income going to be then? What's my tax rate going to be then if everything stays the same? You don't try to guess tax law, but you do guess, like, I think in 10 years, I'm going to get 3 or 4 more promotions. So I'm going to be making a lot more money. That may influence the way that you decide to do things with your employee stock. So should I sell? Bottom line. Most important thing is to understand the tax costs and then the benefits of selling now. So definitely a good thing to get with a tax pro on and say, hey, I'm thinking about doing this. Here's my documentation. I'm thinking about doing this. And a good tax pro will say to you, here's what would happen if you did it now, and here's what would happen if you waited till X and Y, X date, and then let you make the decision. Because obviously, a lot of times we get these RSUs, they're part of our compensation. Maybe our salary is even a little lower than it would be if we didn't get those RSUs. So we get them and we need the money. So even if our tax person says, I don't think that's a good idea to sell right now, you do it anyway. But ask your tax pro. You'll notice that on this slide, we don't mention RSUs. That's because there is no such thing as qualifying disposition versus disqualifying disposition in RSU. And we'll get to that in just a moment. So the next slide, all about RSUs. Generally, the value of the RSU is frozen at the date when it is granted. So like I said, there are different vesting schedules, but a common one is you say you get RSUs when you sign on to your job. Half of them will vest in 6 months, a quarter at 3 months after that, and the rest 3 months after that. So by the end of your first year of employment, you have vested all of your stock options that you were given. And then your bonus the next year may follow a similar schedule. So as they vest, as I mentioned before, that value that was frozen at your grant date gets included in your taxable income for the year. And how does that work with taxes? So most of the time, what employers will do is they will say, okay, we're going to hold back a certain number of shares to pay your taxes on your behalf, to withhold your taxes. So if they granted you 10 shares and you owe $100 in taxes, and I'm just using regular whatever whatever numbers, but you owe $100 in taxes, or you expect to owe $100 in taxes. That's what your withholding would be on that um, income. And each share is worth $100. They're going to hold one share back and only actually give you 9. This can get a little complicated if sometimes companies only hold back whole shares. Sometimes they'll do partial shares to get your withholding just right. And so you kind of have to, and if it's whole shares and you work for a company that the shares are worth thousands of dollars a piece, they might end up withholding too much. So you want to check with your employer and see if they have options on whether you can opt out of that withholding and you can just maybe pay the taxes out of your own money, or decide how you want to do that. Maybe sell a couple shares and pay the taxes. Anything you would like to do, but good to find out what your options are as far as withholding goes. Often at the end of the year, if you in a year that you sell RSUs, you will see on your 1099-B that comes from your brokerage a sale that looks like you have zero basis. So it looks like if you sold that share for $1,000, you had $1,000 in capital gain. That's just generally the way it is. Usually there'll be another page. If you have a good brokerage, there'll be another page, a couple pages down, that tells you, hey, this is your actual basis for this. Make sure you put an adjustment in. So when you do your taxes, your basis is going to need to be adjusted. In years that you sell RSUs, maybe a good year to get a tax preparer and make sure you don't overpay in your taxes. So I just wanted to kind of break this down into 5 rules. Number 1, know if the benefit you're being given for your work is taxable. If you're not sure, a good rule of thumb is to ask your employer if they intend to withhold taxes. If they do, it's probably taxable. You can also Google it. This is all publicly available information on an IRS publication. Number 2, consider when to sell employee stock options. Tempting to, as soon as you have them, just sell them because you need the money, but it might not be the best idea. And if you can wait, it can be extremely valuable to do so, especially if you're receiving ISOs. Never assume that a reimbursement given to you by your employer is just a reimbursement. It doesn't matter what they call it. Payments in exchange for services are taxable unless the IRS has already made an exception. And if your employer isn't necessarily up on all the rules, they may not withhold taxes properly, and so you're going to want to keep an eye on that. Factor in capital gains when you're making withholding or estimated tax decisions. A lot of times people who receive employee stock are not necessarily stock traders, so they're not used to factoring capital gains into their taxes on a yearly basis. And so a lot of times I've had clients that just said, well, they gave me the stock, so I sold it. I didn't know that it was going to make me owe all this money. Well, just make sure that if it can happen. You can get really lucky. Your RSUs get granted at a valley in the stock price, and then when they vest, the stock price is way through the roof. When you sell that, you're going to have some considerable capital gains based on how much you made and how many shares you're selling. So be careful with that and make sure that when you're making decisions about withholding and about whether to pay quarterly estimates, things like that, you factor in the capital gains that may come. And then 5th rule, if you're not sure and you got something like this going on in your taxes, ask an expert. Absolutely ask an expert. You don't want surprises when it comes to your tax return, especially when it comes from your employer. We think of like, I'm a W-2 employee, it's so simple. Things like this can make it a little more complicated. So ask an expert. It can be well worth the money to do so, especially these can be really big financial decisions. So I just open the floor up to questions. And yeah, thanks guys for listening.
All right, thank you for that, Adam. Anyway, I do have here a question from our live audience. Kent, I know when I sell my stock, I pay tax on the gain. Are there any other taxable events that happen?
So that's a good question. It depends on how you got them. So like I said, if it's an RSU, technically the vesting itself is a taxable event. Usually it doesn't result in a balance, usually the shares are withheld when you do that. So even though your W-2's gone up, your withholding also goes up. So it's good. But keep in mind that can also push you into a new bracket. And so that's something to look at as well.
Okay, thank you. Second question here. This is posted in our live stream through chat. This is okay. What is the cost basis on my stock? Do I get that from the broker I sell it through?
Yeah, great question. So when it's employee stock, the cost basis can sometimes be difficult to find. If you have a really good brokerage, like I've seen, like I'm not advertising for anybody, but like different 1099s will have different kind of levels of information included with them. If you have a really good one that includes some schedules and some additional information that can help you determine the basis, that's good. I mentioned about RSUs. A lot of times on the 1099, the RSU will show a reported basis of 0. That needs to be adjusted and that's because the brokerage doesn't know when that RSU was granted. They only know when the shares were deposited into the account. So they don't know the value on the grant date necessarily, unless the employer has provided that information. And when the employer provides the information, the broker gives you kind of the additional statement, but just make sure you don't claim it as 0. If you call the broker and say, hey, what's my basis? Generally, they're going to say, I don't know. They're going to say, this is what we reported, and that's all I can tell you. So if you're not sure, I would definitely ask a tax pro. That information can be gleaned from the various paperwork that comes from employee stock plans, but you have to get used to figuring it out. And maybe you can go to see somebody once and they'll show you how to figure it out, and you have that same job for 20 years and the rest of the years you can do it. But definitely important to get it right.
Perfect. Thank you, Adam. So this is the third question. I think this is going to be the last. This is through live stream again. Do I pay tax on the incentive stock I get when I sign my employment agreement?
So I want to be careful because the words are very precise. So if it's an incentive stock option, then no, there is no taxable event necessarily when you sign on and they grant it to you. Nothing happens. Incentive stock options, nothing ever happens until you exercise them. There's going to be an exercise date and you have to choose to exercise them, right? On that date, there technically is a quote unquote taxable event, but for most taxpayers, it doesn't result in any tax due. It's only an alternative minimum tax calculation. In general, with incentive stock options, you don't actually pay any tax until you sell the shares. But if you're using the word incentive and your shares were paid as restricted stock units, little bit different, right? So it's just be careful and know what you're being given, because they do make a difference.
All right. Awesome. All right. That is actually our last question for today's session. Anything that you want to add?
No. Hope everybody has a great night.
Well, thank you very much. We have learned a lot. And well, thank you, Adam, for tonight. And that covers our questions. And that's it for today's session. And there we go. Our commitment now, I want to thank you, by the way, for attending. And our commitment is to help you reduce your taxes and increase your wealth. We do this with the TriTax method of DIY, do it yourself, DIT, do it together, and DIA, do it all. Three methods, one solution. Reduce stress from no IRS or state tax debt and a happier, healthier life. If you are not yet a member, please join for less than $20 per month. We need your support to continue to offer more of these sessions. Since it is now tax season, we have many sessions to help you do a better job of doing your taxes yourself. And of course, if you want help, we have a team of experts who can do your tax return for you. Please check our website at taxresolutionhelpcenter.com. And please join as a member today for $19.95 per month. Thank you for all attending. Have a wonderful evening.